Good morning. This webinar offers closed captioning. Welcome to the City of Chicago Department of Business Affairs and Consumer Protection's free business education webinar. This webinar is being recorded and will be available at youtube.com/ChicagoBACP. There will be a Q&A session at the end of the presentation. All BAC webinars are part of the BACP Entrepreneur Certificate Program, which is a free program for anyone interested in starting or growing a business in Chicago. Getting your certificate is as easy as 1, 2, 3. 1, register. 2, attend. 3, graduate. Graduating makes you eligible to apply for a CIBC Bank Entrepreneur Loan Program. For full details, visit chicago.gov/BACP certificate. Views, information, and opinions expressed during this webinar are those of the presenter and not the official policy or position of the City of Chicago or BACP. The information mentioned will be posted in the chat box. Today's webinar will be How to Prepare Your Company for a Successful Exit, presented by SCORE Chicago. Turning it over to Luntadia.
Good morning, everyone. I am so excited to be here with you today. My name is Luntadila Paulo. I'm a CPA and Managing Director of Yeto Accounting and Tax PLLC. I'm going to be sharing with us today about a topic that, unfortunately, there isn't a lot of information yet for business owners like you and me. So that I know that I am speaking with the right group of people, can you put in the chat or the Q&A how many years you've been running your company? Okay, just put a number. If you've been running for a year, just put 1. If you are 5 years into running your company, 5, and so forth. Okay, let's see how many years we've been collectively running our company. I can see 14, 13 here. Let's see how many years we can see from other folks. Okay, we have people who are new. Okay, exciting. 12, 7 years. Okay, thank you everybody for sharing the number of years you've been running your company. 10, thank you. Now I want to ask you a question that is going to be one of the prompting question that is going to lead us throughout this entire presentation. So for those of us who've been running our firms for at least 5 years, okay, what would happen to your company if you no longer could run your firm today? Let's say, God forbid, but you became impaired, you became ill. What would happen to your company, God forbid, if you die? What's going to happen to your firm if you no longer was there to run the firm? Okay. Somebody, Natalia said the business would stop. Okay. Let us see some more answers coming up here. Okay, I'd like to get your answer. What would happen to your company if you would not be there to run the company for at least 1 to 3 months? Okay, my husband would have my staff take over. Okay, we're seeing the business would stop. The business can continue, but it would be a hard transition. The business would go to my children, would be given to the children. It can sustain 3 employees. Okay, we're seeing some responses here, and thank you. And by the way, for those of you who have, I'm assuming you have a transition plan, a written transition plan, and you also have, you've been training your people to actually be able to run the company with or without you, correct? Okay, we're seeing here sell, wife would run until I return. It's scary to think about it. Okay, thank you so much for your answers. I really appreciate your engagement and your openness to share with all of us essentially what could potentially happen. And the reality is, this is exactly what the vast majority of business owners across the US have to face, have to deal with. And let me tell you why today's webinar is so important, is so valuable to all of us. I'm a business owner and I think about these very same questions every single day. And I'm trying to position my own firm in a way that no matter what happens to me, my company is going to be sustainable. My family is still going to be able to have a livelihood to make ends meet. And we're not gonna, or the people who are gonna stay after me are not gonna suffer financially. Okay. And the reason this became such a big passion for me the past 1 year or so is because, especially for those of us who are thinking about one day selling our companies, okay, I used to work as an investment banker. And as an investment banker, I would be assigned to clients that essentially, when they came to me based on my previous work with private equity funds, family offices, other business buyers, I knew this company would not be able to sell, even though the owner wanted to sell. Many times, business owner would come to us seeking to sell their companies, and we knew these companies weren't ready for the business owner's exit. And that really kept coming over and over and over. And the problem is the fact that many business owners, probably some of them are in this webinar, have been expecting that with the sale of their companies, they can get some cash to fund their retirement or other projects in their life or travel the world. But what we know today is, on average, a business to be able to sell takes at least 18 months. That's the average time frame. But a lot of business owners, they get a call from a broker and they think their company will sell the next day. Okay, that's not what happens. And for the vast majority of businesses, we know only 1 out of 12 businesses ever get sold. 1 out of 12. And those who get sold, we still have to deal with the fact that most of these business owners do not get their desired outcome with the sale. And when I talk about desired outcome, I'm talking specifically about 3 major things. Number one, the price they wanted to get. The vast majority of business owners who sell their companies don't get the price they wanted to get for the company. Number two, they don't get the terms that they wanted to sell the business under. And throughout this presentation, you'll learn that the price you sell your company is not the same as the terms you get the company sold. And number three, they do not get to sell the company during the timeline that they expected the company to be able to sell. So this presentation is really designed to help you prepare your company for your exit, whether you will transfer to your family, to your children, to your spouse, to your other relatives, or if you are planning to one day sell your company. Either way, you will have a way that you will have prepared a company that is actually valuable enough for you to transfer and provide you the outcomes you desire or you expect to get. So I'm gonna skip my introduction here. You'll get the slides if you want to get a copy. And I'm gonna go straight into how this webinar will also benefit you. 3 things. You'll get the foundation about what the process looks like if you plan to one day exit from your company, and how you can increase the value of your business so that you can get amazing outcome. Is everybody following me so far? Okay. I love to interact with my audience. So if you're following, please put a yes there so that I know you're there, you're following me, and we can learn together. Okay. Thank you. Thank you so much for your responses. Number two, I'm going to share insight that you can take today and go make changes, or at least start considering to make changes to increase the value of your company. And number four, these insights are going to be so practical that you're not going to have doubt. What do you need to do to actually fix what's not okay in your company so that you can get to a place where you know exactly what to do and how to do it? Okay. So that's what we're going to try to do together. So the first thing, let's start with the big picture. Probably most of us here have heard of Simon Sinek, his book Why, right? Starting with why. And that's really the beginning here. Why now and what's next? This question is essentially trying to help us figure out, okay, why do I want to start preparing for my exit? What am I looking to achieve with my exit? Okay. So let me give you an example, maybe to help us make a connection here. In 2022, I had a client that just came. And by the way, my firm is not a business broker. We don't help sell companies. Okay. That's not what we do. And you'll learn why we don't do that throughout the presentation. They came when I was supporting another team as an investment banker for them, and they wanted to sell their company. We told that client, hey, look, your company is at $100 million revenue, but your profit is very thin, very, very, very small. In a good year, they would make $1.5 million in earnings, right? And that's less than 2 million, this less than 2% profit, okay? And I knew if they wanted to move forward to sell the company, they wouldn't be able to get the financial outcome they wanted to get. They were expecting to get at least 12 million from the sale after tax. Okay. And that's very important. We live in America, we live in the US, and taxes are part of our lives. Okay. When you sell a company, you have to pay taxes on it. There are ways that you can avoid paying the taxes, but that's outside of the scope of this conversation. But their goal was to get at least 12 million after tax. But based on our experience with working with companies similar to theirs and other business buyers, that company would never, ever sell at even $10 million. And that's really what we kept seeing. People would be coming and would say, I can pay five. Those who wanted to pay close to 10 or $12 million, they weren't willing to put a lot of cash upfront. They were comfortable paying up to 5 million upfront, and the remaining of cash will be paid in the future years based on attaining certain metrics. So for you as a business owner, what are you expecting to get financially, time-wise, after your exit? For those of you who are considering, if something happens to me, my children will transition into running the company, or my spouse will transition, or we will sell the company. Let not use that as, let's say, a catalyst for your exit. Let's say you expect to enjoy a little bit more of your life by not running the company and pursuing other interests, okay? What are you looking to achieve, number one, financially? What are you looking to do with your free time? Most of us as business owners work 40 to 60, sometimes 70 hours a week or even more. As a CPA, I work a lot. I work too many hours, in fact. And probably some of you are in the same boat. Meaning, if you and I decide to exit from our businesses today, we're going to have so much free time without much to occupy our life with the time that suddenly we have available. So the question is, what are you going to be doing with that free time? And if you expect to get to, let's say, to sell your company at $5 million or even $1 million, what are your plans with that cash? Are you planning to just retire and live off from that cash? Or are you planning to invest it into other business opportunities? What are you planning to do? So when you get this slide, I would strongly encourage you to go into this portion, okay? And add here your answer. Give us maybe 7 whys you're here. Why you're starting to think about your potential exit, okay? And I touched on a little bit what you'll do after you exit, okay? Somebody put here, Natalia put, they would buy properties and invest for passive income, okay? And thank you, Richard. They're getting close to the end of their working career. And I would suspect that that's gonna be the reason for a number of folks, you know, typically in the US, we love working. We love, building careers that are meaningful and being useful for other people. And that's all very, very well. Okay. Europeans tends to enjoy more leisure than working. Many of my European friends, they I feel jealous because they tell me that they can take over 1 month of holiday vacation without having to think about work. So that's a different conversation. So what are you going to be doing after your exit? Okay. And we talked a little bit on how much money do you actually expect to get? Okay. And a similar question to that is really to think about, okay, based on where I hope to go, okay, based on how much money do I need to get, will my company be able to actually provide that level of financial outcome that I need for my company? Okay. Oh, excuse me, for my life after the after my exit. And this is my first gift for you. I've written an ebook that covers 7 exit mistakes that business owners seeking to sell their companies make. And it's gonna go into a number of the ideas I'm sharing with you today. You can get it for free. Just click the link. Once you get the presentation, you'll download it. I have 3 gifts for you today for attending our webinar. So the first gift is this one, free ebook. You get it, read it, and it's gonna be very helpful to you. Okay, let's keep moving. Let's talk about undesirable time for an exit. It's a bad idea to want to exit when these 3 occurrences are taking place, whether it's in your personal life or in the overall business or economic cycle. Number one, do not try to exit when you have a family emergency. Okay, a family situation that is forcing you out of the business. Okay, things like a divorce, a separation, or your children live in a different state and you suddenly feel a strong need to just leave the company to go spend more time with your children or grandchildren, that's not ideal. That's not ideal for you, okay? Even if you're sick, trying to sell the company, a major illness, you'll certainly lose significant amount of value, right? In practice, we say distressed seller, right? When a seller is distressed, when, you know, in to put it nicely, right? The business buyer will say motivated seller, right? Motivated seller, somebody with a very strong incentive to get their business out of their own hands and transfer it to somebody else's hands, right? When you have family emergency, please do not sell. That's part of the reason we're starting to have these conversations so that you can prepare your company for your exit. Ideally, you're not only preparing, but also increasing the business value so that you can get the outcomes you intend to get. Number 2, do not sell your company when it's in a strong decline, okay? When your revenue have been flat and even declining, your profits have been very small, thin margins. similar to the client we had in 2022, when your products are getting to the end of their lives, or you have a high employee turnover, some of the major issues with your business fundamentals, not a good time for you to sell, okay? And number three, when the economy is in the decline. Even great businesses will sell at a much lower price than in good economy. So if your business have problems and then the economy is bad, that's a really bad combination for you to exit. So the good thing is we're here today to start setting up this foundational item so that you can prepare your company to move in a favorable direction when your time for exit arrives. That way you don't have to deal with either negative outcomes or that is under your control or even outside of your control. Okay. So any questions so far? Everybody is following us. Okay. Now we're gonna be starting to move into the 6 phases, okay, of preparing your company, okay, for your exit. And some of them are I'm gonna spend a little bit more time than the others. Some of them I'm gonna spend a little bit more time than others because of our time, but I wanna make sure that we save a little bit of time at the end so that we can have opportunities for questions, okay? So let's begin with preparing your business for sale here, okay? Where do you begin? Where do you start, okay? The number one thing that business owners needs to know when it comes to preparing their business is to think about not themselves. What do I want to do with this company, but rather if I intend to sell this company or transfer it to my future heirs or family member, what are the things that matters the most to them, right? Just like in sales, what I tell people I do is irrelevant. What I can do for people is what matters to them, right? For all of us who understand sales, and I believe we have an audience here who probably understands sales better than I do, okay? We know that unless we are solving somebody else's problems, to them, whatever we do, it doesn't matter. So here's what you need to think about. If you plan to sell your company, what exactly is in the mind of a potential business buyer that they are looking for to find in an ideal company to acquire? And then we need to ask ourselves, is my company in alignment to what these potential buyers are looking for? Okay. So here's the 3 things we know that business buyers generally, irrespective of industry, irrespective of sector, irrespective of geography, what they want. Number 1, they want to acquire a profitable and cash flow positive businesses. Okay. That's generally the rule. There are other folks out there who are comfortable buying the so-called distressed companies, businesses underperforming, but generally, business buyers want to find the profitable and cash flow positive businesses. And ideally, they want to find a business that is generating at least $500,000 in earnings and at least $1 million in revenue, okay? If your business hasn't reached that level yet, the type of buyers who will approach you to acquire are probably not gonna be the most ideal type of buyers, okay? Number 2, business buyers want to find a business with very clear business processes, systems, procedures, okay, in place that can be operate without somebody telling them every single day what they need to do to create and deliver value to business clients. And number three, a company with a clear succession plan, meaning a company that can operate without you. My goal here is to share this idea that you are a potential liability to your company as long as you continue to be the only person capable of running your company, the only person capable of making decisions, the only person who knows how to do almost everything in your company. Here's another example. Last year, we were working with a remodeling company, okay? And what we realized, the business owner really did build an incredible business. There were over $4 million in earnings, in revenue, and over $1 million in profit. When you look at that company on paper, it looks great until you realize that the business owner was the CFO in the company, the COO in the company, the CEO in the company. He was overseeing project managers. He was, bringing, even the head of sales was essentially the owner of the company. When you start thinking about, okay, if this business will ever sell, the potential buyer will need to replace the CEO, will need to replace the CFO, would need to replace the COO, would need to replace the head of sales. When you bring together a budget for these four positions, what you actually end up realizing is that the budget for these four people that are critical for the company continue ongoing concern would be at least $500,000, right? Their entire compensation package, okay? Meaning that the true profitability of that company was really embedded into the owner himself, okay? And the company's true profitability wasn't $1 million, was slightly below $500,000. So you as the business owner could be a big disadvantage to your company as long as your company depends exclusively on you for its survival. So these are the three things that a potential business buyer is really be looking at the first glance of your company. Now, here's the more granular things that you need to start thinking about when you are looking at on your own company, okay? So revenue-wise, potential business buyers are looking for companies with a growth rate of at least 15%, double-digit growth, right, in the last 3 to 5 years. They're looking for size, revenue of at least $1 million. They're looking to see a company with a history of accurate sales projections. And sadly, and this is really sadly, because most small businesses across the US do not have sales projections. They have no clue. They don't have it documented what they're gonna be making in the next quarter, in the next year, in the next 3 years, much less 5 years. Okay? They run the business and they see what's gonna happen. That's not the best way of running your company because there is a lack of predictability. Can you predict what's gonna happen based on your history? Okay? Potential business buyers, they want to see a company with long tenured clients, meaning clients have been in your firm, have been recurring, they've been coming over and over and over, year after year. Now, I do understand that certain industry are largely designed in a one project at a time, okay? For example, remodeling companies, construction companies, okay? They're gonna have, job-driven revenue model. Even in this kind of situation, we still wanna see that they are opportunity either for upsell or cross-sell, okay? There is opportunity for recurring revenue, okay? So whatever your business model is, right, you need to make sure you really do understand your revenue breakdown. You really need to understand what are the major clients in your firm. right? We have a presentation that we've done around revenue analysis and revenue concentration. That is a great piece of work we've done to teach business owner how they can study meticulously their own revenue to understand clients with risk and client that provide stability to their company. That's going to be a great piece for you if you want to check it out on our YouTube page. In terms of your operating costs, I want to call your attention to two major items. Almost all of us business owners are running certain level of personal expenses into our companies. When I say personal, they may not be necessary for the business, but they are necessary for us, and the tax code allows us to claim them as tax deduction. Things like our own healthcare. Some of us are members of professional organization. Subscription we use. Maybe your business provides you a car, or you have a building that you rent to your company, but they aren't necessarily a clear distinction, excuse me, or difference between what is yours and what is the business assets, or what is yours and the business liabilities. All this kind of confusion makes your business less credible in the eyes of a potential buyer of that company. So you really want to make sure that, number one, your personal expenses are minimal to your main business, okay? And number two, you want to make sure that your operating expenses are reasonable or close to the fair market wages. One of the big plays that we don't see this happening is salary for the owner or salary for people related to the owner. Here's another great example. We had a client that has a daycare, and their daycare was generating over $800,000 in revenue, but their salary was literally less than $50,000 year over year. Anybody can see a problem there. Yes, there is a problem, okay? Because not only from compliance perspective, that's inaccurate. When the IRS one day, if ever, audits them, they will be recategorizing some of their distribution as salary, and they will have to pay a lot of back taxes and penalties because they weren't, number one, being compliant with that tax, with that portion of their business. There are other folks out there who will tell you if you are an S corporation or a C corp, you don't have to pay yourself a salary. That's not entirely true. That's not the entire story. That's why we always tell our clients, you gotta know the rules. And the rules say you have to pay yourself a reasonable salary for somebody in a similar position to yours. If you hired a CEO, okay, let me ask you this. If you hired a CEO to run your company, would you pay them $50,000 and they will be happy? You're probably not shaking your head and saying, no, you're not gonna go with $50,000 annual salary as a CEO, okay? So why do you think it's reasonable for you to pay yourself such a low salary? Okay, that's a different conversation. So we want to make sure that the expenses we are reporting are reasonable, are close to fair market. They are minimal expenses from our personal lives into the business, okay? And our operating expenses are stable and predictable. And let me touch on a little bit here. When we talk about predictability and stability of your operating expenses, right? If you have, in good year, we expect, for example, your salary to stay slightly constant and maybe just an increase according to, inflation rate. Unless you had major hiring or firing of employees, okay? Then it justifies a little bit of fluctuation there. But here's something that we see taking place occasionally. A business owner, because you're changing accountant all the time, one accountant will be putting certain expenses in the COGS or cost of goods sold. And the next year, because they changed the accountant, and they will come and say, oh, no, we should put that into operating expenses. And you see the cost of goods sold fluctuating year over year, as well as operating expenses fluctuating year over year. And that's not an ideal situation. That's not a good place for you to be. Okay. There gotta be consistency. There needs to be stability and predictability. Okay. Otherwise, there isn't really good information to make decision based on. Let's look into the balance sheet now. So far, and everybody's following where we are. Okay, we are addressing your profit and loss statement, and now we're moving into a balance sheet because they are two of the major items that a potential business buyer would be looking at. Okay, we need to address some of these red flags so that when somebody approaches your company, you are not in a defensive mode, or you do not know why they're asking you certain things, or even how to address these things that they're asking you. Okay, you can tell me my accountant needed to know this. It's their job. I pay them for that. But in the eyes of law, courts, and the IRS, you are the ultimate responsible person for your company, and therefore for your financials. Okay, I didn't know is not a valid excuse. Okay, many times we have to sit with our client and just be blunt with them. Okay, I don't like going around the bushes, because I prefer that my client tell me, you know what, I don't like what you're telling me, than giving them false hopes, so that tomorrow when something doesn't go well, they will come and tell me, hey, why didn't you tell us this? Why didn't you see this coming? After all, that's why they're paying me, to help them see the future, to help them prepare for the future, and make sure that if anything adverse is going to happen and it's going to be material, we can plan for it today. And you're doing exactly that. You're starting to think about, okay, where I'm going to in the future, what potentially could happen, and how should I start preparing for my exit today, okay, by looking into what potentially could be taking place in the future. Okay, so let's go back to the balance sheet. You need to show a balance sheet that is strong and growing. Okay, many small business owners don't have a complete and clean balance sheet. They have a lot of off-balance sheet debts and liabilities. Not a good place to be. Not a good place to be. If you operate in a capital intensive type of businesses or industry, right? Let's say you are in manufacturing, you're producing, let's say, insulation material or equipment, right? We really want to see a story of growing balance sheet, okay? Because if you're not reinvesting into the company, you're not building or buying new machinery, it means in the next 10 years, whatever repairs, maintenance, or asset replacement you didn't make, somebody else will need to come and make it for you. And therefore, guess what they're going to try to do? They're going to want to have a discount in the selling price for something that you should have done and you didn't do it. Okay. So we really want to make sure that you are addressing the right areas of your company. If you are in a tech-driven business, we want to see a history of growing intellectual property. Okay, we want to see that happening. Potential business buyers also want to see a simple equity structure. Okay, a company with very confusing equity structures is not ideal. Is not ideal. We also want to see fewer liabilities or contingencies, low debts, and no off-balance sheet agreements or liabilities or contingency. So far, if you're following me, please, I just want you to just type one, just one. I will know that you're here, you're still following me, and this is valuable to you, and this is actually making any difference to you, okay? And meanwhile, I'll have a sip of coffee. Thank you. Thank you so much. Thank you. Um, you know, I give you some good information. You give me back some fire with your participation. So we're all happy here. Thank you, thank you. So the next area that we want to look at is the business focus and implementation. So let's look into two major items there, right? Your strategy and your operations. When we are looking at your strategy, the biggest question is, are people outside of yourself as a business owner have a clear understanding of what your company does? They are crystal clear about your value proposition. What exactly our company do for other people? What problems are we solving for other people? Are you clear with the answer to that? Okay. Are your people clear with what your company does? Okay. If you cannot answer this question objectively with a yes, right, it's a really good place for you to stop and think about it. Okay. And think about it. Do you have a viable competing strategy? Okay. Are you in an industry that is not in decline? And even if it's in decline, you have found a way to continue growing with your company. Okay. We're exploring your level of execution of your vision, of your strategy. What makes you different to other company? Okay, we are a remodeling company. We are an HVAC business. We are, an electrical engineering company or an IT company. Okay, so what? What makes you different? What differentiates you from the rest of the folks? Okay, and I didn't even realize this about our firm. And the reason a lot of people come to us apparently is because they think we can communicate and explain things in a way that they understand. Apparently, I also didn't know this, accountants, CPA have a bad reputation when it comes to communication. We don't know how to communicate. We talk in language that most people don't get. So the fact that we can explain people, we can meet with people, we are responsive in a way we do our business, apparently that's what differentiates us to many other accountants. And I think we'll continue doing a good job there, investing our time and resources there, right? So what is that makes you different, that differentiates you in your industry? Let me jump quickly here in operations because of time. Okay. When it comes to your operations, what is your offer? What are you selling to people? Is it commoditized? Is it such a low cost that automation is gonna replace it? A lot of people today are starting to think that accounting is gonna be replaced by automation. I disagree. It's not gonna be anytime soon. As a CPA, I am not even by any chance scared of automation or IT. By no mean, by no mean at all. Okay. But when it comes to your industry, what are the trends that are taking place that could disrupt your product or services? Okay. Do you know what are they? What are some of the mega trends, okay, whether taking place in Europe or Asia or Latin America, in Africa, okay, that could impact your company's future, okay? When it comes to operations, I'm gonna come back to these. You really need to make sure you're investing into your processes, your systems, okay, your procedures. And, I like to think of franchises, okay, because they have built a model that it doesn't matter if the person is highly educated or not, as long as they follow the process, they can do almost every single job within the organization. Can you say the same thing about your company? Can you get a high school to come and still do the job? Can you get a graduate from a bachelor degree, four-year university, and come and still do the job with minimal training? what can you say about that? Okay. Are your staff currently well trained? Do you have a management team that is capable of running the business in your absence, right? Just think about some of these areas that we have here, right? A lot of us business owners are still in a place where we're doing our own finance, we're doing our client acquisition, we are the people doing the hiring, we are the people oversee our staff doing the work in value creation. We are setting up our own strategy, okay? And at the end of the day, we are the business, but we cannot be sold. We cannot transfer ourselves to our children as inheritance for as a new generation of business owners. So you really need to start thinking about, how do I create systems around these processes, around these functions, around these responsibilities, and how do I begin delegating this work to the people that needs to become very good at doing their job, okay, and not me doing everything, okay? So we are about 30 minutes to the end. So I'm gonna skip a few things here. I have my second gift for you, which is a business health check. And you can download this once you get the presentation. You can download this, and then this is gonna take you to a workbook. Just answer some questions here, and it's gonna give you your score here for your business, okay? So this is my second gift to you for coming to our webinar. So documentation for sale. I'm gonna sprint here. So you gotta make sure that you have financial statement, profit and loss statement, balance sheet, statement of cash flow, okay? For the last 5 years at least. You need to have your tax returns that are accurate, the last 3 years of tax returns. Other documents and information, things like your operational data, your contracts, your KPIs, projections, budget, industry-specific information, any reports applicable to your business, and so forth. Gift number 3, here's a free checklist about different areas of your business, but this covers, we literally use this workbook, okay, for our internal work with clients. So we're gonna give you one piece of it, that is the financial checklist for items that you need to get correct for your preparation as part of your preparation as well. Okay, so how your company's value is determined. When somebody comes and say, hey, I want to buy your business, here's my offer. Here's some of the things that they are considering when deciding the value of your company. Number one, they can determine your company based on the income approach. Secondly, comparable approach. And lastly, cost replacement approach. Let's quickly look into each one of these. Under the cost approach, we're really looking into the value of your company, right? The book value, the liquidation value potentially, right? We're looking into the balance sheet. If we can put together all of your stuff in the balance sheet and solve them, how much could we get from there? Or if we need to rebuild this company, how much would we have to spend to rebuild a company like this? Excuse me. So the cost approach, it is really in terms of, we're looking into heavy asset industries, right? So we're really thinking about, the type of industry. Oh, here's another great example. We recently had a client that have an helicopter tour business, right? They had about 7 to 11 helicopter, and they also did private charter, right? Their business was producing very good cash flow, but the value of the helicopters were higher than the value of the valuation of the company if we only use the income approach, okay, that we're gonna touch in a second here. So we needed to get the appraisal done for the helicopters first, and then we would look into the operation. So we split the company into two. One side we had the assets appraisal. under different LLCs to protect each one of the helicopter, okay? And then on the other end, we had the operating entity that is the face that clients interface, okay? So the cost approach could be very good for heavy asset type of businesses. Number two, the comparable approach. This is a little bit risky, and I see a lot of mistake other folks making here. I see a lot of mistakes because there is a temptation of comparing businesses that sometimes are not necessarily similar. It's like comparing apples and oranges. It doesn't work. You can't compare, a technology company, an advertising company, and use Google as another company to compare them. It just doesn't work that way. There is a proper methodology that needs to be used, okay, that needs to be paid attention to before this methodology needs to be used, okay? Both cars here look great. They look amazing, but one is Ferrari and another is Ford. We gotta know the difference. Otherwise, we can be comparing two cars that do not necessarily, or rather two companies that do not necessarily have these similar fundamentals or similar metrics for comparison. And number three is the income approach. This is the most widely used for small business valuations, right? Oftentimes, we're using a multiple, an industry multiple times your earnings or times your cash flow, okay? This is typically the metric. So for example, if your earnings are $500,000 and the average company in your industry sells at 5 times, then we know your business can be valued at $2.5 million, right? 5 times 500,000 of your earnings, right? But the big danger here is to understand whether that 500,000 is actually accurate, right? And as I said earlier, right, there are situations where when you think that your earnings are correct, but in reality, there are many things that goes into your earnings that shouldn't be there, right? That either needs to be removed or needs to be added to actually normalize, okay, your financial statements. Let's talk quickly on some of the common mistakes, right? Some of the common mistakes that people make in valuing company is sometimes they just use the wrong methodology. You're valuing a a company with significant amount of capital asset, fixed asset, and you're using a methodology that doesn't do service to it. Sometimes people use false comparison, right? And the way this usually manifests itself is when somebody is valuing a company today and they're using the market data from the pandemic, for example. We know during the pandemic, most industries were down, especially in 2020 and 2021. Most industries were down. If you use this period as a cutoff to value companies today, you could be making a big mistake, right? Using unreasonable assumption. That's another type of mistake we see. Ignoring the overall picture, right, of the company, right? Sometimes when professionals run evaluation, they only look at the financial side of things. They didn't do a walkthrough into the facilities to see problems. They didn't talk to employees of that company to see their perception of their work in the company, which could have been areas of risk. Imagine a company that, let's say, it's valued at $5 million, but the CFO is not somebody of good integrity or character. I'm not sure I can trust the financial reports they are producing, okay? Or the staff are heavily dissatisfied with top management. I know something is gonna happen sooner or later. Excuse me. So it's very important to pay attention to some of these flaws in terms of valuation. When you decide to sell your company, right? So we're moving to number 3 here. Your business broker is going to start preparing some material to share with potential business buyers. Number 1, they're going to need to put together non-disclosure agreement, an NDA. Ideally, you want to include these 2 items, a non-solicitation and non-compete clauses into this document. Why? Because a potential buyer may become aware of key information of your business. Therefore, they cannot use that information to compete against you, to try to hire people from your company, or to try to compete to steal your clients. Okay. So NDA, very important. Number 2, they will prepare a teaser. A teaser is a document. If you go online in any business site or website that lists company for sale, you'll see a teaser. And the teaser is essentially a summary of your company without including the name of your company, website, or location of the company. Just gives general information of the opportunity. And if you're interested, ask for an NDA. Once you sign that NDA, they will give the confidential information memo that includes information about your company, right? Location, operations, industry, key financials, vendors, products, and so forth, right? So that's gonna need to be prepared and needs to be prepared accurately. Some additional information for your due diligence, okay? Your speed to exit depends largely on your ability to provide information to potential buyers, okay? So you gotta assemble all of the information for your company, okay? So we talked about financial statement, employee records, customer data, contracts, agreements, engagement letters, pipeline reports, operational budget, variance analysis, and so forth. If you are in construction, you'll need to provide a lot of job reports, okay? Engineering reports, and so forth. Let's move to the ideal buyer profile. Okay, somebody is asking, we'll address all the questions at the end. I'm seeing here in the chat some questions already, but we are almost there. We're almost there. Ideal potential buyer, right? They are largely, 3 major groups of potential buyer, but you really want to you really want to consider people who can add value to your company, okay? If they buy the business, they can be able to add additional value to your firm, and they would be a good fit to your company, right? Culturally, they will integrate to your company without significant disruption. And number 3, somebody who actually has the ability to close the deal, right? It doesn't matter if they know how to add value and they could be culturally fit, but they do not have the financing you need to close the deal, okay? And for that, there are 3 types of potential buyers, as I said. Number 1, insiders. Insiders are people in your network, in your family, business partners, right? Vendors, or even clients who potentially could buy your business. Number 2, strategics. Those are typically your competitors, across the same line of business or vertically. It could also be, a raw material provider or somebody who you sell to. Essentially, your clients and vendor could well fit here as a potential strategic. And then you have financial buyers who are essentially the type of businesses or individuals motivated to acquire your company to gain a high return on their capital, right? So we're looking at private equity firms, family offices, independent sponsors. Some hedge funds also do acquire companies, and M&A companies, right? Companies that are set up just for the purpose of acquiring other companies, okay? So these are your types of buyers, okay? And the way you find a good buyer for your company, generally, we recommend that you find a potential intermediary, an investment banker, an M&A advisor, business broker. Make sure to check their credential, their previous experience, their reputation, somebody trustworthy. And as I said at the beginning, we are not business brokers. We don't do that. We don't try to sell your company. That's not our job, right? And that's why we're here to tell you, hey, you gotta be skeptical. You gotta pay attention. You gotta interview the professionals you work with. You can also try to find a potential buyer organically, people you know, and ask them if they are looking for good opportunities, or somebody on your network opportunistically reach out to you looking to buy your company, okay? But at the end of the day, you only get good outcomes with your exit if you manage to prepare your business for your exit, and you address some of the red flag, if not all of them, before you actually exit your company. Okay, let's keep move on. We're gonna skip the first meeting, but here's the thing. The first meeting is as much as about the buyer meeting you and learning about you, as well as you getting to know the potential buyer and decide whether or not they're gonna be a good fit for you or your company, your culture, and your aspirations. Okay. Good thing is you're gonna get the presentation. I believe BACP is gonna send the presentation to attendees for your records, okay? If it's not there, we're just gonna post it online on our website, and you'll be able to find it there. Recommendation when working with business broker. Make sure you get a list of everybody they send a teaser of your company or present your company's information and material. Ask them for weekly updates on your company's activity in the market. Who did you reach out to? How many people responded? Who said yes? Who said no? Why are they saying no? What can we do to increase the attractiveness of the company? And part of that is preparing your company today, starting to preparing it today, okay? Make sure to know the entire time that is required from you, how much information, what kind of information that is going to be required, okay? And have a clear target market development KPIs. These essentially means, you have to give your business broker or investment banker clear timeline and clear metrics that they need to hit every week, every month, okay? Exiting from your business is a long process. It can take months, it can even take years. And I've seen companies going to the market, spending months, years. The seller realize, okay, this is not gonna sell anytime. They go off, they remove the company from the market. A couple of years later, they go back without fixing the issues potential buyers were complaining, and still not be able to sell. So don't be that kind of business owner, okay? Navigating due diligence. Once you find your potential buyer, you start receiving offers. What's gonna happen? It's gonna be a really challenging time, because you'll need to provide a lot of information, and this information needs to be passed on a confidential manner, in a transparent manner, and in a way that is safe and protects you, your company, and your team, okay? So when you get an LOI or an IOI, indication of interest or letter of intent, okay, that document is typically going to present you with the deal structure, how a potential buyer intends to acquire your company, the timeline they have to close a deal, and what they're gonna need in terms of due diligence, and that's gonna be in your next steps, right? So here's just an example of a potential indication of or indication of interest, right? The price, the amount of money they look to buy this firm, okay? we're looking also into the structure, how much they expect to acquire from the company, and what gets what, and how the company is going to be funded. Okay, typically they are parts that are binding and parts that are non-binding. Okay, but you'll get these, and you'll review these with a little bit more calm on your own time. This is an example of how a potential due diligence checklist could look like, okay? Some of the question and additional documentation requests. So pay attention here, right? Number one question, why are you looking to sell the company, right? That's gonna come 100% of the time, unless you're selling to somebody who doesn't have a clue what they're doing, okay? Look at some of the question here. These are really specific to your company, okay? And they're gonna be asked based on specifically your company, okay? They're gonna ask you for, how do you determine pricing for your jobs? What's the measurement of unit of economic of a job, right? Does management have a list of potential acquisition candidate? If you expect to grow to acquisition, have you identified certain company you hope to acquire? Okay. And in what geographies, right? And so forth. So this is very important for you as a business owner, okay, to make sure to compile all this information. So some of the best practice ideas are preparation is key. Okay, you need to prepare, and the sooner you begin, the better. You need to start organizing your documents and file, your financial, operational, taxes, legal, commercial, and so forth. You gotta have your deal team ready, okay? You need to start interviewing people, especially if you plan to exit in the next 3 to 5 years. You gotta need to start assembling people that are gonna be critical for your success. You need to have a prompt, open, and transparent communication. You need to address concerns and red flags before potential buyers find them, okay? Before they find them. You just need to say things the way they are, no dodging, no going around, no trying to, paint the pig with lipsticks or try to make it look nice. If it's ugly, just say it's ugly. Here's what we're trying to do to fix it. Or if we can't fix it, we're happy to finding a compromise. That's it. That's it. No going around the bushes. Okay. Negotiating, closing, and transition. Your negotiation team, excuse me, really need to have your best interest in heart. They need to know what they're doing, why they are there, and the outcome you expect to get out of that transaction. You need to have the minimum deal term that is acceptable to you. But sometimes negotiation is about trade-offs, okay? What am I willing to give away, and what absolutely I'm not willing to move an inch away from, okay? Sometimes you have trade-offs like exiting with a high price versus exiting quickly. You have a trade-off between staying after you exit or getting a lower offer because the potential buyer cannot reliably trust that you're not interested to stay because they will uncover things, and you don't want to be there when stuff starting blowing up. Another trade-off is between selling 100% of the company or leaving a minority stake in the firm so that when it's sold tomorrow or in the future, you'll get what the famous second bite of the apple. Those are some of the trade-offs that you need to remember. But here's an important observation as well. We can't get everything every time. We have to think about what am I willing to give away and what I am not willing to give away at any possible corner or chance, okay? Once we have that, once we have the negotiation, we have an agreement in place, your lawyers start, drafting the purchase and sales agreement, and then the closing checklist will come to you so that, you can starting to prepare for, final preparations for your exit. And after you sign your contract, everybody is happy, your purchase and sales agreement, then comes your what's next. If you wanted to exit and move with your life, then that's your next. If you wanted to exit and stay around for 6 months to a year, that's your next. If you wanted to exit and go invest in real estate, buy properties and flip properties, that's your next. If you wanted to sell your company and move to Mexico and enjoy your life there or somewhere else or in the US, that's also your next. So this is essentially the end of our conversation. This is our contact information. I'm gonna I don't know if this is gonna be posted online. These slides are gonna come through email or not, but either way, I'll try to put it here in our website. And yeah, I'm gonna move into the Q&A section if um, we have questions. So I'm here available. We still have about 15 minutes. So send your questions. I am ready for them.
Perfect. Thank you so much for a great presentation. I just
Thank
put
you.
in the chat where the recording will be posted. And let's look at some questions. I'm getting a lot of thank yous, awesome content. So I'm just trying to get through the thank yous right now.
Thank you. Glad you made it.
Regarding increasing the attractiveness of a business, how late is too late?
How late is too late? Um, so the way that I tend to think about this is not necessarily in terms of how late is too late, but what can you reasonably do to increase the attractiveness of your business given the time constraint. Let's say you only have a year, okay? Then you have less priorities to work on. So let me give you an example. So last year, or rather at the beginning of this year, we had a client operating in solar panel installation. Okay. And they had three major problems. Number one, they had a company with significant amount of debt and they were looking to sell the business. Number two, they didn't have a strong management system in place that require them to stay after they exit. And number three, they had an issue where their processes were not organized around the business. They were organized around the owner of the business, two different things. Okay. So when they came, it was really urgent to help them find money, number one. Okay. So because without the cash, they wouldn't be able to actually service their debt, operating expenses. So instead of going for helping them prepare the company for sale, we ended up actually going into how do we help you find money? But their company was so toxic and became toxic by the day because of the amount of liability they had. And literally no bank wanted to touch them. And let me tell you this, it was one of the saddest thing that I have that I had to deal with in terms of working with business owner because they employed over 70 people and all of these people had to be let go, literally, because the business had to shut down because we couldn't help them find money on time. We reached out to over 100 banks, literally over 100 banks. And that was too late for them. The time they came, the bomb already was off. The only thing that we could do is to minimize the chaos, helping them find an attorney to file for bankruptcy, to keep certain things, to keep their house intact because they still have children that are under 15 years of age. That was too late for them. Now, for your specific business, you really need to think, okay, where am I in terms of my exit? How many years do I have? And I've, hopefully, with the help of a professional, you have evaluation done, and that valuation also gives you a list of things that are a potential issue for your exit. And then if you have less than a year, you need to decide where do you want to put your focus on to address the most important things. Now, if you have 5 years, maybe you can address all of it. But if you have just a few months to a year, then maybe you can only work on 1 to 3 things. Okay. That would be my answer to that question.
Okay, great. Thank you. Another question. Can a business be sold without a business broker?
Yes, 100%, but it's not recommended. Unless you have sold many businesses, you've learned with your mistakes because you'll make a lot of mistakes trying to do it on your own, right? In general, I do not recommend anyone selling a business without at least 3 professionals. Number one, your attorneys, your accountants, and your business broker or investment banker. Okay. Typically, investment banker will not touch businesses below $1 million in earnings. Business brokers are gonna be okay with businesses below $1 million in earnings. Okay. I would not recommend anyone try to sell their business on their own, even if they have sold 2, 3, 5 businesses. Okay, because that's not what you do. That's not your profession, right? I wouldn't try to remove my own tooth. Okay, no matter how broke I were, I would not try to do that because that's not my craft. That's not what I'm trained for, right? So don't go that way.
Great. Thank you. In a restaurant business, what we will do if I don't find a buyer? What do you do if you can't find one? Any suggestions?
Well, I would need to learn a little bit more about the situation specifically and consider other options, right? So after assessing, okay, what do we have? Maybe if it's somebody with family member who also love the restaurant space, maybe they could transfer the company or sell to, family members and get money, not necessarily in a way that they wanted to get the entire cash upfront, or they can liquidate the assets, okay? Or, they can simply hire an outside CEO to manage the company and they move on, right? Sometimes that's actually what we do. Instead of selling the company, we hire somebody who is trained to start managing the company, right? Under the client supervision, right? After 6 months to a year, right? They get to start reducing their involvement in the business. If in the past you would work 7 days a week, after 3 months, maybe the target will be reducing 1 day of the week. After the following 3 months, reducing another day of the week based on the progress the other person is making. And at the end of the day, we know we have clear expectation for this person, clear metrics, clear cutoff, how they will be evaluated. Okay. One thing we always tell clients across the board is run your business as if you were a publicly traded company. That's really our secret, Okay. And we're going to help you try to do that the best possible way at less cost as possible. Okay. So that whether or not you are there running the company is going to live beyond your lifespan. I hope that answers the question.
Great, thank you. What are the tax implications for getting my desired sales price upfront as one lump sum versus new buyers spreading the payments to me over time?
Another great question. Again, it so your selling price, right? So let's say you sold the company for $1 million. Okay. Number one, depends on how the deal is structured. Is it an asset sale or is it a stock sale? A stock sale, right? You get taxed at capital gains, and an asset sale, right? You can have some form of ordinary income tax rates. So as a lump sum, you get taxed entirely on that amount right there, depending on how the sale is structured. Okay. As a installment payment, you get taxed when, oh, let me actually take a pause there. Your tax preparer need to report your business sale as accurate as possible so that it actually reflect that installment payment. That way you don't have to pay taxes on the amount of money that is not necessarily received yet.
Great, thank you. We're getting a lot of thank yous. Thank yous. They are asking if you could put in the chat the link for the book that you were talking about and also the presentation. The presentation could also be emailed to everyone. I'll send the list to SCORE, and SCORE will be sending it out if you are good with that.
Sure. I can put all of these links
Yeah.
on an email with to SCORE, and then they can be shared to everybody else.
That would be great. That is the last of the questions. I'm getting great seminars. Thank you so much. This has been so informative. Thank you, thank you, thank you. So just overall big thank you from BACP. Thank you. Appreciate your time. Everyone, thank you for attending and I hope everyone has a safe and dry and fun weekend. Thank you so much.
Awesome. Thank you. Cheers. Bye-bye.